Yes, everyone. By the time you listen this video, you have already completed your CA final examination. And I hope everyone have done exceptionally well in your examination. In this particular video, we'll be discussing the solution of the descriptive part of CA final financial reporting question paper which was asked in your exam. So that you can go through that, analyze the solution and can understand how much you can score from CA final financial reporting paper. The solution of part 1 case study related MCQ is already provided in my previous video and I hope you have already gone through that. But if you have not listened that particular video, the link of that video is also provided in the description of this video. Now generally what happened, even though if I provide my solution of this particular question paper, you will have lot of queries as per your solution is concerned. Now the doubt is what, who will solve that queries? So what I have decided that I will come live online in YouTube at one particular point of time in which I'll be dealing with all your queries related to your solution. But for that I'll fix one target. Target is 100 like and 100 comment in this particular video. Means once I receive 100 like and 100 comment is the indication that you want me to come online to solve your queries as per your solution is concerned. So I'll be waiting for that particular target. Once the target is achieved, we'll fix one particular point of time in which we'll be discussing all your queries related to your solution. Now, can we start a discussion of solution of the descriptive part? But before we start the discussion, don't forget to subscribe this channel if you are new to this channel. And if you feel that this video will really help you, share this video with all your friend. Can we start a discussion? Now this is the part 2 of CA final financial reporting question paper. From my point of view, whatever question have been asked this time, almost all the questions were from ICI module. Now whatever new question they have asked, that were either similar questions given in ICI module or they were directly related to concept. Means if your concept is strong, you have done practice from ICI module, you can attempt all the questions. Most of the questions were from my expected list also, directly from my expected list. And I hope if you have gone through my expected list, you have realized that. Now, from my opinion point of view, this paper was not lengthy. Once again, I will say if your concept is strong and you have done practice from ICI module, you can easily solve the entire question paper in 3 hour time. Once again, I will say this is my opinion. Your opinion may be different, and if your opinion is different, just message me in the comment box so that I can understand what is your opinion regarding this question paper. Now let us start a discussion. Now let us start with the question number 1. Question number 1 is from Consolidated Financial Statement. I will say whatever question they have asked. Similar question we have done in our classes. Similar question is in ICI study material. So this is not a new question. You may be confused only in one point, as relative debenture. However, in the previous attempt, similar point was asked in exam. Got this point? So it was a manageable question. You can easily manage in exam hall. Let us discuss. The balance sheet of H Limited and S Limited as on 31st March 2024 were as follow. You can see the balance sheet has been given. You can see property, plant, equipment, financial asset, investment S Limited. Of course, investment S Limited means investment in equity shares of S Limited. This will become purchase consideration. 1000 debenture in S Limited, 1500. This is the point where you might have done some mistake. Then current asset, inventory, financial asset, trade receivable due from S Limited 160 lakh. So 160 lakh is intercompany balance which will be cancelled. Dividend receivable 320 lakh means this is also, I will say, a new point. Means of course dividend adjustment is not a new adjustment, but whatever question we have done in the class or whatever question has been given ICI module, in all question dividend declared by the subsidiary company is paid. So if it is paid, it will not come in the balance sheet. But in this question they have said declared but not paid, and therefore it is coming in the balance sheet. Okay sir. So of course common sense is required. Dividend receivable, so there will be some dividend payable in subsidiary books, so that will be cancelled, and whatever related to NCI, that will remain in the balance. This is a common sense wala point. Cash and cash equivalent, okay sir. Equity share capital, other equity, retained earning, to only there is a retained earning. Non-current liability, you can see 13% debenture of rupees 100 is 3000, means Can I say all the debentures were not held by H Limited? All the debentures were not held by H Limited. Financial liability trade payable due to H Limited 120 lakh. So you can see out of 160 lakh, only how much is coming in the balance sheet of subsidiary company, that is 120 lakh. Okay, the difference will be check in transit. Already we discussed in the class कि any difference in payable and receivable will be check in transit. However, that information is given. Dividend payable is 400, so you can see 400 minus 320, so of course 80 belong to NCI, that will remain in the balance sheet, and the 320 part will be cancelled. Other liability is given. Additional information, point number 1, on 1st April 2023, S Limited had 400 lakh shares or rupees 10 each and 3000 lakhs in its retained earning in other equity. So opening balance of equity share capital and opening balance of retained earning has been given. However, you can see from the balance sheet the equity share capital is 4000, means there is no changes in the equity share capital during the year. H Limited acquired 80% shares of S Limited on 1st April 2023 at a consideration of 5800 lakh in cash. So 80% acquired or 20% will become NCI, and 5800 is what? Purchase consideration, that is reflected in investment, means there is no other investment in the balance sheet. Okay, sir. The following changes in the book value of INA has been given. This point number 2 is for fair value adjustment. So they have given, you can see for PP, book value and fair value, and for inventory they have given book value and fair value. So this is required for fair value adjustment, means to calculate fair value of INA. They have also given rate of depreciation on PP is 10% per annum. Okay, sir. Then NCI was to be measured fair value. Fair value method will be applied based on the PC. So we need to calculate proportionate amount of PC for 20% NCI. Goodwill was impaired by 100 lakh, so 100 lakh will be goodwill, and because can I say there is a fair value method, so there will be full goodwill, so impairment loss will be attributable to both parent company and NCI. Okay, so the amount of impairment has been given. H Limited sold goods worth rupees 200 lakh to S Limited on a credit at a profit of 20% of sales. So this is a downstream transaction. So we need to calculate unrealized profit, which will be eliminated. 50% of goods will were still laying unsold. So 50% are unsold stock, from which we need to eliminate URP, unrealized profit. S Limited issued a check of 40 lakh in favor of H Limited as a part P payment of goods purchased from it on March 2024. The check is yet to be received. Already I have said that 40 lakh was the difference between 160 and 120. That 40 lakh will be check in transit. Dividend payable represent dividend declared out of pre-acquisition profit. You can see it is already declared but not paid, and therefore coming in the balance sheet. H Limited credited its share of dividend from S Limited to his profit. Means if you are confused about this particular point, and dividend payable and dividend receivable is given in the question, so you might have done mistake. However, nothing to be applied much. Whatever you have done in the previous type of question, same adjustment is required for this. Prepare the consolidated balance sheet of group as on 31st March 2024. Manageable, means I will say super simple. If you are not confused about a debenture wala point and thoda sa dividend wala point, can we start a solution? So you can see already I have solved the entire question. Only I will discuss the solution now. Now the PDF of this solution will be soon uploaded in my Telegram channel. The link of the Telegram channel is also given in the description of this video. So join our Telegram channel to download this particular PDF if you want to download. Correct? Yes, sir. So you can see working note number 1. What I will do, fair value adjustment. So there are two fair value adjustment for that. Asset is given, PP and inventory. Fair value has been given and book value has been given. So we'll find out fair value gain or loss on the date of acquisition. So for PP there will be fair value gain, for inventory there will be fair value loss. Okay, yes sir. Now can I say whenever there is a depreciation, we need to also calculate, whenever there is a rate of depreciation given, we need to also calculate additional depreciation for post acquisition period. So additional depreciation, because the rate of depreciation is given, nothing has been given, so always we will use reducing balance method. However, in this question, if you do SLM also, the same solution will come. So 2800 is the fair value, book value is 2500. So we'll do 2800 minus 2500 on 300. Will apply to 10% rate of depreciation, that will come 30. So this will be the post acquisition additional depreciation, which reduce from post acquisition profit. So this become the net increase in PP on the date of consolidation. On the date of consolidation I am saying. Similarly, inventory, we have assumed that it remain unsold. So we have assumed that whatever inventory was acquired from subsidiary company that remain unsold during post acquisition period. However, a different assumption can be also taken, that it has been assumed that it has been sold. But as per ICA solution, normally we assume that inventory whatever has been acquired that remain unsold during post acquisition period. If the question is silent, so we have taken that assumption. Therefore, the entire 300 will be adjusted on the date of consolidation also. Chalega? Yes, sir. Then working note number 2 will do analysis of profit. Analysis of profit. So only one reserve and surplus, means other equity has been given return earning. The closing balance is 5,000. Opening balance is given 3,000. This all information is given in the question only. So this become profit after dividend. Can you say in this will add dividend declared, dividend payable? So dividend payable is 400. It is given in the balance sheet. So you can find out from that dividend payable is 400. So this become profit before, this become profit before dividend, means the profit earned during post acquisition period. So now this will be allocated to pre-acquisition and post-acquisition period, but because the date of acquisition is at the beginning of the year, the entire profit will be post-acquisition profit. So entire profit become post-acquisition profit, and entire opening balance will be the pre-acquisition profit. So entire profit become entire opening balance become pre-acquisition profit. So this become pre-acquisition profit, this become post-acquisition profit. From this we reduce the dividend whatever has been declared. So once again will minus dividend payable. So this become the pre, and this become post acquisition profit after dividend. Post acquisition profit after dividend. However, what you can do, you can transfer this 2,400 and this 400 separately in other equity calculation. That is your choice. Means I am doing on net basis, you can do on separate basis also. Means you can calculate profit before dividend, and first you allocate profit before dividend, and then you also allocate dividend to parent company NCI when you do other equity calculation. That is also okay. But normally in my class I do in this way, therefore I am following this particular solution. Chalega? Yes, sir. So this become analysis of profit. Now we'll prepare one statement of net asset. Statement of net asset on the date of acquisition and on the date of consolidation and post acquisition period. Correct now. So equity share capital 4,000 given in the balance sheet. There is no changes during the post acquisition period, and return earning from previous working note we can say 3,000. It become 3,000 from this working note, and 2,000 in the post acquisition profit. This become 5,000. This become the total. In this we'll do fair value adjustment as per working note number 1, whatever we have done. So PP, you can see PP was increased by 300, and there was a post acquisition depreciation adjustment 30. So this become 270 as per working note number 1. And inventory, there was a fair value loss, means inventory was reduced by 300. So your net asset on the date of acquisition will be also reduced by 300, but there is no post acquisition adjustment, and this will remain on the date of consolidation. So this become the fair value of INA on the date of acquisition. This become post acquisition profit. This become post acquisition profit after fair value depreciation adjustment. So this become post acquisition profit, which will be allocated to parent company NCI, which can be allocated to parent company and NCI. Correct. So that I have allocated in 80% and 20%. So this is the allocated profit we have calculated. Understood? However, what you may also do, means what you can do, 2,400 was the profit before dividend. Correct. Now from this you can do minus 30. So 2,400 minus 30 into 80%, how much? So you can also allocate 1896 and 474, and then do also dividend adjustment from this, means do minus 400, means 400 ka 80% how much, means 320. You can do separate minus 80, you can do separate minus from this, means you can also allocate in this way. That is your choice. Correct. Now so I am saying I have done on net basis. Okay sir, so don't be confused with my solution. Chalega? This you have understood. So this statement of net asset also done. Now we'll come to the calculation of goodwill or gain on bargain purchase on the date of acquisition. Correct. So for that we require purchase consideration, that is given 5,800. Then 20% NCI we need to calculate. They have said proportionate to PC. So if 5,800 is 80%, so how much 20% you will take? So 5,800 divided by 80 into 20, that is 1450. This become the total 100%. Now from this you will minus fair value of INA, which we already calculated from previous working note, that is 7,000, and this will be the full goodwill on the date of acquisition. But out of this, how much impairment loss is given the question, that is 100 lakh. So minus 100 lakh. So this will be the carrying amount of goodwill which will appear in the balance sheet, consolidated balance sheet. Okay sir, very simple working note. Now we'll come to working note number, next working note, that is unrealized profit. The unrealized profit for downstream transaction. The downstream transaction means goods have been sold by parent company to subsidiary company. Okay, sir. So it has been given that total goods sold is 200 lakhs. You can see total goods sold is 200 lakh, out of which 50% remain unsold. So 50% remain unsold. Unsold goods means 100 lakh, and the profit margin they have given 20% of sales. You can see the profit margin they have given 20% on sales. So 20% of 100 means URP is 20. URP, unrealized profit, is 20. Correct? Understood? So this unrealized profit, because this URP, unrealized profit of parent company, will be directly adjusted with other equity, that is retained earning, when we do that calculation. Okay, sir? Yes, sir. Now I'll come to other equity and NCI. So retained earning and NCI will do find out. So retained earning opening balance we have taken from parent company balance sheet, and this NCI from previous calculation means this is the NCI valuation on the date of acquisition. Now we'll do plus sharing profit of subsidiary company as per our working note. How much we have allocated? 1576 and 394. So you can see 1576 and 394. Yes, sir. Now from this minus URP, because it is downstream transaction, so entirely will be deducted from retained earning 20. Then there is one impairment loss on goodwill, because it is full goodwill will be attributable to both parent company and NCI in 80:20 ratio. So impairment loss was 100, so 80:20, 80 lakh and 20 lakh. Now this is a good point. Debenture, you can see I need to explain this point. What they have given is the total debenture in the balance sheet of subsidiary company 3000, and it is of rupees 100 each. Means can I say it is how much lakh? 30 lakh debentures. 30 lakh debentures means total debentures issued are 30 lakh debentures of rupees 100 each. Out of that, how much is held by parent company? 1000 debentures. 1000 debenture. But from my point of view, actually it was rupees 1000. From my point of view, there is some typo mistake. It was rupees 1000, but that has not been given. So we need to consider 1000 only. 1000. So it is 1000 debenture in S Limited. So 1000 into 100. Can I say it become 1 lakh? Means the nominal value is 1 lakh. Nominal value is 1 lakh. So nominal value of debenture, investment debenture, is 1 lakh, which has been acquired at 1500. Which have been acquired at 1500. Correct? So you need to cancel it. So when you will cancel it, how much extra you have paid for acquiring this debenture? That is 1500 minus 1, that is 1499. So this become loss on cancellation of debenture, because you need to cancel it now. So you need to cancel 1 lakh debenture. You need to cancel 1 lakh debenture from consolidated balance sheet. Means what journal entry will do? Debenture account debit, means debenture account debit 1 lakh to investment in debenture 1500. So how much loss is coming? Loss is coming 1499. 1499. So this loss on cancellation will be transferred to profit and loss account, means through retained earning it will be adjusted. Understood this point? I think here you might have done some mistake. Might. But if you have understood, it was not complicated. From my point of view, if you have considered this as rupees 1000, so you have done mistake. Chalega? Okay, sir? Okay, sir. So you can see 1499, this loss on cancellation of debenture has been adjusted from retained earning, and this become the final balance of retained earning and NCI, which will appear in consolidated balance sheet. Okay, sir? Correct? Then last point is elimination of intercompany balance. That journal entry I have provided, however that journal entry is not required. That is check in transit is 40 lakh, trade payable is 120 lakh will be cancelled, trade receivable 160 lakh will be cancelled from CBS. Now we can prepare CBS. So you can see non-current asset PP will come. This is book value plus 270 adjustment. This is simple. Then goodwill will come as per working note. Current asset inventory will come book value plus book value, whatever has been given, minus that fair value adjustment, and minus URP will come. This will come. Trade receivable, book value plus book value, minus 160 will come. Cash and cash equivalent, book value plus check in transit will come. This is the total of asset side. Share capital will come. Other equity as per working note, that is other equity working note 16,297 and 1824 NCI will come, that I have written. Correct. Borrowing, be careful, it will be 3000 minus 1, because 1 lakh was the debenture which has been cancelled, nominal value debenture which has been cancelled. This become 2999. Current liability, trade payable, book value plus book value minus 120 lakh, which will be eliminated. Dividend payable 400 minus 320. So 400 minus 320, 320 will be eliminated and 80 will remain in the balance sheet. Correct. This is dividend payable to NCI. However, some of the solution, this 80 has been can be shown with NCI also, because this is attributable to NCI. It can be added to NCI, but we'll go as per this solution only. Means it is quite possible in the final answer given by ICI, this 80 might be added to NCI. 80 might be added to NCI. Other liability will remain same. This become the total and balance will tally. Chalega. Super easy. I hope you have understood. Question number 1 done. Can we come to the next question? Okay, sir. Now let us come to next question. The next question number 2A is from financial instrument chapter derivative. It is a question of derivative instrument. Once again, same to same question is given in ICS study material. Same to same question we have done in the class. Correct now. So I think no doubt about this. Let us read. On 1st Jan 2023, Joe and Company Limited, an Indian listed company which prepare its financial statement on a quarterly basis, has entered into return put option. Now, put option means right to sell. So, holder have a right to sell. It means writer will have an obligation to buy. So, in this, can I say Joe and Company will be a writer of put option. So, they have an obligation to buy. Obligation to buy what? For US dollar 40,000 US dollar with Box Limited to be settled in future on 31st December 2003 at a rate equal to 78 per US dollar at the option of Box Limited. Joe and Company Limited did not receive any amount upon entering into contract. Means nothing, no consideration was received on entering into contract. Chalega means the fair value of this derivative instrument on initial date will be 0. For the purpose of accounting, use the following information representing mark to market fair value of put option contract at each reporting date. As on 31st March 2003, it is negative 50,000. Negative means it is a fair value. Fair value, they have given fair value. This is fair value of derivative liability. This is derivative liability. Then liability was decreased from 50,000 to 30,000. Then it become nil and spot rate on 31st December 2023 means on settlement date it becomes 76 per US dollar. Evaluate and explain whether the above option meet a definition of derivative as laid down in Ind AS 109. So they have done two parts. First, you need to analyze whether the contract will meet a definition of derivative or not. If yes, we need to pass journal entry for each quarter till the date of actual purchase of US dollar. Actual purchase means it is physically settled. It is not net settled in cash. It is physical settlement of 40,000 US dollar. Chalega. This is the question. So let us come to the solution. So you can see I have already analyzed the question. Return put option, they have an obligation to buy $40,000 at 78 and fair value is given nil, then 50,000 negative, 30,000 negative, nil. And can I say the spot rate on this settlement it becomes 76? It means, can I say they have an obligation to buy at 78 even though the price becomes 76. It means it is an unfavorable situation. Unfavorable means it will be derivative liability. So 2 into 40,000. So fair value of this forward contract, fair value of this return put option on settlement date will be 80,000 negative. If you have understood this, so can I say in the first quarter there is a loss of 50,000. Loss of 50,000, then your liability decrease. So they gain of 20,000. Gain of 20,000, then once again gain of 30,000, then once again loss of 80,000. This we need to find out. Chalega. So first I have done the assessment for derivative contract. So you first write down the meaning of derivative contract. So derivative contract is a financial instrument which satisfied all the following conditions. What are the conditions? Is value changes in response to a change in the fair value of underlying. Here the underlying is what? The dollar, 40,000 US dollar. Is response, it require no or it require very low investment. Correct. So in this there was nil investment. It is settled future date. Because all these conditions will be satisfied, therefore the derivative is a return put option. It is a derivative liability which will be initially recognized at fair value and subsequently recognized at FBTP at fair value through PL. Then journal entry, you can see no journal entry on 1/1/2023 because no consideration was received initially. The fair value on initial date will be 0. Then second journal entry on 31st March 2023, will be fair value loss transferred to PL to derivative financial liability 50,000. Correct? Understood? Then there is a gain of 20,000. There is a gain of 20,000. So derivative financial liability to fair value gain, then that fair value gain will be also transferred to profit and loss account. Then again there is a gain of 30,000. Derivative financial liability will decrease by 30,000 to fair value gain. Then there is a loss of how much? 80,000, the fair value loss, which will be transferred to PL to derivative financial liability, and now the liability will become 80,000. Now we'll do the settlement journal entry. So we'll buy what? Dollar. So bank account dollar 40,000 and we'll purchase at spot rate, that is 76. Means the fair value of this dollar will be recognized at fair value at 76, but will pay 78 as per our contract price, and the difference will be 80,000. Difference will be 80,000. With this, the derivative financial liability will be closed. The account will be closed. This is the journal entry. However, you can also compound this to journal entry if you want. Compounding is also chalega. Yes, sir. So this was, I will say once again, very simple question. No doubt about this. Coming to next question. Question number 2B. Spicer Limited is a question, and similar question we have in our question bank. Similar question, I will, from my point of view, that question I have taken from other source, means previous old scheme of syllabus I have taken, the same question have been asked in exam. Correct? So similar question we have in our question bank. However, similar question we have in ICAR resource also. Correct? Now nothing, no method, no difficulty in this question. Spicer Limited, a listed company, prepare interim finance report at the end of each quarter. Following information is provided. Question related to Ind AS 34. On 1st April 2023, Spicer Limited has brought forward losses of 620 lakh under income tax side. No DTA has been recognized by the management of the company on such losses in view of uncertainty over the company's ability to earn profit in the foreseeable future and set of losses. Means no DTA was recognized. Since can I say DTA was not recognized in the previous year, the question of reversal will not arise in current year. Due to sudden change in the government policy, the company business turned around and it has reported quarterly earning of 650 lakh and 360 lakh respectively for the first 2 quarters of the financial year 2023 and 24, and anticipate net earning of 720 lakh in the coming half year ended, of which 160 lakh will be the loss in the quarter ended. If someone has not read the question carefully, or they have read the question carefully but they have forgotten, they will take all this, they will take this plus this plus this plus this. How many have done this mistake? If you have done this mistake, so it means you have not read the question carefully. Means can I say your total accounting income of the year will be 650 plus 360 plus 720, because 720 is the half year ended, means last half year earning they have given, out of which third quarter there was a loss of 160. There was a loss of 160. So if you have not read the question carefully, it is quite possible you have done mistake. How many have done this mistake? Comment in the, please message in the comment box so that we can understand. Yes, you are doing some information mistake. If you are doing information mistake, then just try to understand this is whose mistake. You need to understand this point, how the marks are deducted, why we are not getting the marks. Okay, the tax rate for the company is 25% with a surcharge of 10%, means it will become 25 into 10%, means it will become 27.5%. Okay sir, you are required to calculate the amount of tax expense to be recorded for each quarter. Okay sir, let us understand. So first we need to calculate effective tax rate in this. How to calculate effective tax rate? First we need to find out total accounting income. Total accounting income is 650 plus 360 plus 720, that is 1730. Then we need to find out current tax. So we'll deduct brought forward losses, that is 620 lakh. This become taxable income. Current tax will be 27.5, that is 305.25%. 305.25. This become your current tax. Now we'll find out deferred tax, but can I say because DTA was not recognized in previous year, the question of reversal will not arise, and deferred tax is 0, and there is no temporary difference given in the question, and therefore deferred tax will be 0. So this become the total tax expense. Now we'll find out effective tax rate. Effective tax rate will be total tax expense divided by total accounting income. That will be 17.6445%. 6445%. You can do 64% or 64 whatever you want to write down, but you can do rounding of this percent also. So 17.6445%. When I take 4 decimal, the accurate answer will come, therefore I have taken 4 decimal. Now if you multiply with each quarter profit or loss, you'll get the each quarter tax expense. You can see in quarter 3 it was 160. So quarter 4 it will be how much? Quarter 4 it will be 720 plus 160. 720 plus 160, that is 880. I hope you have understood this part. Once again, simple. If you have not done the information mistake, if you have done some information mistake, means you have not read the question carefully, then of course some marks can be deducted. Some marks can be deducted. Chalega? Yes, sir. Now let us come to the next question. Come to the question number 3A. Question number 3A. Anand Limited on a building X. This is a question related to Ind AS 40, and same to same question is given in ICS study material. Same question I have given my expected list, and the same question have been asked. Correct. In my marathon batch, if you have done that marathon batch, I have said this question is 100% expected and this question have been asked. Okay, sir. Anand Limited on a building X which is specifically used for the purpose of earning rental. The company has not been using the building X or any of its facility for its own use for a long time. The company is also exploring the opportunity to sell the building if it gets reasonable amount in consideration. Following information relevant for building X for the year ended 31st March 2024. Building X was initially purchased for at a cost of 120 crore. At a time, the useful life of the building is 10 years, out of which 5 years have been expired on 1st April 2023. So 5 years has been expired. It means we need to calculate accumulated depreciation of 5 years. The company follows straight line method of depreciation. During the year, the company has invested in another building, building Y, with the purpose to hold it for capital appreciation. From the question, it is understood that building X and building Y are investment property. The property was purchased at the beginning of the year at a cost of rupees 20 crore. Expected life of the building is 20 years. As usual, the company follows straight line method of depreciation. Okay. Further, during the year 23-24, the company earned income and the income the following directly related to building X and building Y. So they have given some income and expense related to investment property, rental income of X, rental income for Y. Then they have given some expenses. You can see these are the all direct operating expense. Then they have given some information for disclosure. The company does not have any restriction and contractual obligation against building X and building Y. For complying with the requirement of Ind AS, the management sought an independent report from the specialist. This all point, whatever has been given now, this all point is for disclosure purpose. You can read it. You are required to show how the building X and building Y would be treated in the balance sheet of Anand Limited. Provide detailed disclosure and computation in line with the relevant Ind AS. Treat it as if you are preparing a separate note and schedule of the given asset in the balance sheet. Now, from my point of view, it is quite possible you have not drafted the answer properly, because they have given you need to also write down detailed disclosure and computation, means working note is also required. And you need to prepare one extract of balance sheet. So if you have not drafted the solution properly, marks can be deducted. However, the question was very simple. It is easily understandable. Let us do the solution. Correct. So first I will prepare the extract of balance sheet. Extract of balance sheet, you can see. Okay, sir, of Anand Limited as on 31st March 2004. So in the extract of balance sheet, non-current asset will come, under non-current investment property will come. I will give note number 1. This is the amount. This amount, for this amount I have done one working note. So the measurement and disclosure of investment property as per Ind AS 40 are as follows. So you can see investment property, the gross book value. The opening balance was what? They have purchased the opening balance. Already they have one opening balance of 120 crore. And they purchase one property during the year of 20 crore. Total become 140 crore. Chalega. Then accumulated depreciation. Opening balance of accumulated depreciation will be 120 divided by what was the useful life? Useful life of the first building was how much? I have also forgotten. It was 10. 10 into 5. So you will do divide by 10 into 5. So how much it is coming? 120 divided by 10 into 5. That is came is 60. So 60 become opening balance. Then add current year depreciation. So depreciation of first building will be 12, and second building, because it was acquired at 20, and the useful life is also 20. Useful life, you can see the 20 now. So you can see it has been acquired at 20 crore and useful life is also 20. So it means depreciation will be 1. So depreciation 1. The total depreciation of current year will be 13. So this becomes 60 plus 1373 and the net book value will be 140. You can see 140 minus 73 is equal to how much? 120. Sorry. 140 minus 73 is equal to 67. This 67 will come in the balance sheet, so that I have written. Okay, sir. Yes, sir. Then point number 2, you need to also write down amount recognized in PL with respect to SOPA, because this amount will be disclosed in SOPA. For that one note is required. So rental income given, then all the directly operating expense given in the question, just sum total it. This, if there is some mistake in sum total, just inform me, because I have done this all calculation in a very fast mode. So there may be some calculation mistake. If there is some calculation mistake now, do inform me. Chalega na? Let me check once again. It's coming 1.3. So 1.3 karo. So this become profit from investment property before depreciation, then minus depreciation of current year. This depreciation of current year is nothing but this 13, and this become what? Profit from investment property. Then other disclosure, this all disclosure whatever I have written, this is as per the information given the question. As such, the investment property consists of building X and building Y whose fair value as on 31st March 2024 is 105 crore. It is given the question. Then the valuation is performed by independent valuer. A valuation model recommended by International Valuation Standard Committee has been applied. This is also given the question. Fair value is measured by using discounted cash flow method. Key input for valuation investment property. These are some assumptions taken. All the assumptions I have mentioned here as per the information given the question. Then there are 2 points. Company has no restriction on realizability of his investment property, and there is no contractual obligation to purchase or construct or otherwise develop investment property. This all information is given. Means just write down whatever information given the question. If you written properly, you get full out of full. Chalega. Once again, simple question. Let us come to the next question. Next question is about question number 3b. It is a question for calculation of deferred tax asset and liability. I will say new question, but once again, if you are conceptually good, you will not do any mistake. Mahadev Limited has a block of asset with a written down value of 5 lakh on 1st April 2022 for tax purpose. The book value of asset for accounting purpose is also 5 lakh. Now they have become book value of asset for accounting purpose. The date is not given, so of course it will be assumed on 1st April 2022 only. Depreciation is charged on written down value at a rate of 20% per annum for both accounting and tax purpose. Of the entire block, asset costing rupees 50,000 on 1st April 2022, we are sold for rupees 1 lakh on 31st March 2024. It was sold at the end of the year, correct, at rupees 1 lakh. Now one thing, just try to understand. So of course, can you see, even though they have written down value, this is nothing but the opening cost price. We'll assume this 5 lakh is opening cost price, and you are required to compute deferred tax asset or liability assuming tax rate of 35%. Chalega. So can I say, first as per Ind AS 12, we'll find out the carrying amount of the asset. Then we'll find out tax base of the asset, then compare it, find out taxable, deductible, and on that we need to create deferred tax asset or deferred tax liability. So carrying amount at the beginning is what? 5 lakh. It is given cost price 5 lakh. Then depreciation at a rate of 20% 1 lakh. This become 4 lakh. Correct. Then depreciation again at a rate of 20% 80,000. It become carrying amount on this. And on this date, some of the asset was sold whose cost price was 50,000. So can I say, if you want to find out the carrying amount of the asset sold on this date, you will do 50,000 minus 20% minus 20%, or you will do 50,000 into 80% into 80%. That only I have done. So carrying amount of the asset sold, that will be derecognized, and the balance will be the carrying amount of the portion which remain unsold. Chalega. Correct. Now calculation of tax base. In this, you might do some mistake if you have not applied a concept of income tax act. However, one of the similar question I have taken the class ki how to calculate tax base regarding this. Correct now. So tax base, opening tax base as on 1/4/2022 is given 5 lakh. Less depreciation at a rate of 20%. This become tax base as on 31st March 2023. Now after this, the question arises, first we'll deduct sale proceed, first will deduct depreciation. Here you might have done mistake, might. if you have not applied the concept of income tax act, because tax base means as per income tax act. So as per income tax act, first we should deduct sale proceed, and whatever is coming, that will be remaining block, and on this will apply depreciation. On this will apply depreciation at the rate of 20% on the block, that is 2,40,000 will be the tax base. So this become tax base as on 31st March 2024. So you might have done mistakes some yahan par, because of course this type of question has not been given in ICA module, but once again I will say, if your concept is strong, you have done correct. And similar question I have taken in the class, if you remember. Got this point? Have you understood? चलेगा? Yes sir. Now come calculation of, once you have calculated this, the calculation of DT and DT will be very easy. So carrying amount already we calculated, tax base already we calculated, taxable, because carrying amount is more than tax base, this will be taxable temporary difference, and taxable at a rate of 35%, 16,800 will be DTL. Correct. This I have explained ki how this DTL came. You can see depreciation as per book is 80,000. Depreciation as per income tax is 60,000. Means how much depreciation is disallowed in current year. Depreciation disallowed is 20,000, which will be allowed in future. So allowed in future means, can I say, on that, on this will create DTA. Understood? Chalega? So this is depreciation disallowed. How much disallowed? 20,000 is disallowed. And can there was some gain, so there was some gain as per books. What is the gain as per book? That is 68,000. You can see how it is 68,000 coming. You can see 1 lakh was the sale proceed and 32,000 is the carrying amount of the asset sold. So 1 lakh minus 32,000, so 68,000 is the gain in the books. So this 68,000 is the gain as per income tax. Sorry, is the gain as per books, and there was no gain as per income tax. There is no gain as per income tax. So again, this gain will be disallowed in current year and will be taxable in future. So this become taxable, means on this will create DTL. I'm just giving the concept. So 68,000 minus 20,000, that is only a 48,000, and 48,000 we are creating DTL. So this become net DTL. This become net DTL. Understood? This is a concept to explain this. However, this is not a part of solution. This is not a part of solution. Understood? The concept means, of course, for any asset liability, first find out carrying amount, compare with the tax base, because this is an asset and carrying amount is more than tax base. So it is a taxable temporary difference. This is the only concept as per Ind AS 12. Chalega? Yes, sir. Coming to the next question, question number 4A. On 1st April 2020, Peacock Limited started its manufacturing operation by installing a machine in a rented premises. Correct. This is a question related to Ind AS 37 and Ind AS 16, means about the creation of provision for decommissioning, restoration and similar liability. Once again, simple concept, similar question we have done, concept we have done. If you know everything, you can do that. The estimated life of the machine is 4 years. As per terms of rental agreement, Peacock Limited has a present obligation to dismantle the machine and restore the premises into original space. So they need to create provision. The company estimate to incur 6 lakh at the end of 4th year and to restore the premises into the original shape. The borrowing rate applicable to the company is 8%. They have given the present value factor 0.735. If they have given this, you need to apply this only. You are required to advise the accounting treatment of the above and pass necessary journal entry for all the 4 years. 6 marks question. So first you need to advise the accounting treatment. So what I have written, in the given case, Peacock Limited has a legal obligation to dismantle the machine and restore the premises into its original shape. A provision should be recognized at present value of future expenditure as per Ind AS 37. As per Ind AS 16, amount of provision should be capitalized to the cost price of machine. Correct. You can also write down that every year interest will be added to the provision as per Ind AS 37 for unwinding the provisional amount. This para also you can write down. And can you say whatever you have capitalized, that will be depreciated. That will be depreciated. So present value of future expenditure will be 6 lakh into 735, that is 4,41,000. Now 4,41,000 you can calculate interest expense. So that journal entry we have done PP account debit to provision for, you can add on provision for restoration or dismantling, provision for dismantling You can add on. Correct now. First journal entry you have understood. Correct now. Then can you say every year interest will be added? So interest every year, what journal entry? Borrowing cost account debit to provision. 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 Correct. And of course at the end it will be paid. So on the assumption that there is no changes in the estimated amount and actual amount, you can pass one more journal entry: provision account debit bank. Provision account debit to bank. This is on the assumption that there is no difference between actual and estimated expenditure. Correct. Understood. Can I say this? So you can easily calculate by one working note. That working note I have not done. You can give by prepare one amortized cost table. Means opening balance is 4,41,000 every year. Every year you will add 8% interest, that you can calculate. Acha, I have not done journal entry for depreciation. Why I am not in the journal entry for depreciation? Because they have not given the cost price of machinery. Because this 4,41,000 will be capitalized to the cost price of machinery, and the entire cost will be allocated in 4 years. However, you can give only depreciation journal entry for this. So you can do divide by 4. So 4,41,000 divided by 4. Considering the component accounting, you can do 1,10,000. 250. So one more journal entry will come every year: depreciation account debit to PP. Depreciation account debit to PP. That journal entry you can also add. That I have not given. You can add it. Of course you should add it, because they have said pass journal entries. You need to pass all the journal entry, taking the information given the question. So of course that depreciation journal entry, of course you should add. I have not given. Chalega. Okay sir, you can give it. Okay sir. Okay sir. This is also very simple. Coming to next question. Question number 4b. This was one, I will say, simple question, but in only one point everyone have done mistake. Once again, because of this reason I say conceptual knowledge is required. Once you are conceptually clear now, you will not do any mistake in exam. Even though simple question, most of the students have done mistake. Once again I will repeat, conceptual understanding required. When you do only questions, so can I say you are understanding the only information given the question, a different type of question, you'll find some difficulty in examination to understand the information. So conceptual understanding required, and therefore I always believe in conceptual understanding and conceptual learning. Taking a lot of revision class will not help if the revision class is not conceptual, because in revision class all the faculty will not give the concept, they will say what need to be done. Conceptual understanding will come only with the entire classes, with the full classes. Understood? Chalo, let me come to that point. What mistake most of the students have done? Question was very easy. It is a question related to share-based payment. Greater Limited, in order to reward its employee, launch a scheme effective from 1st April 2001. You can read. It is an equity settled share-based payment. According to scheme, each employee has an option to purchase 250 equity shares of the company at rupees 45 per share, provided the employee does not leave the company for 3 years. From the date of launch of the scheme up to 31st March 2024, means 3 years the vesting period. Once the 3 years are completed by an employee, the employee can exercise the option within 1 year by 31st March 2025, means 1 year is exercise period. The closing share price on stock exchange on 1st April 2021 is 91 per share. This is the closing share price. This is the market price of share. And most of the students have taken 91 in calculation of fair value of option. Here most of the students have done mistake. Even though they have, it might be conceptual mistake, or it might be information mistake. They have read the question, but while coming to the solution, instead of taking the other information, they have taken 91. Quite possible. With a face value of rupees 10 per share, a registered valuer has been appointed by the company who derived the price of the option at 75 using Black-Scholes model of option pricing. Already we discussed in the class the fair value option is calculated by two pricing model, option pricing model, either by binomial pricing model or Black and Scholes model. So that they have given. So this information is not relevant also in class. I used to say fair value of option, always take fair value option. That question they have created. There are 750 employees eligible for the scheme. As on 31st March 2020, 25 employees left the company and further 35 employees are expected to leave over the next 2 years. Okay, sir. During the year 2002, 2000, 2020 to 23, a foreign-based company entered into the market, started hiring experienced employees, and because of this reason, a, a high iteration rate is observed in the market. 275 employees left the company during the year, and further 135 employees expected to leave in the next 1 year. As on 31st March 2024, only 400 employees remain with the company out of 750 employees. Once again, who is not reading the question carefully? This is the total number of employees who remain at the end of the vesting period. So, correct now. You need to read the question information. Don't take only the numbers. Out of it, only 375 employees exercise the option, means 25 employees will not exercise the option. You are required to provide necessary accounting entry during the life of the share-based payment. Super easy question, means I will say the question cannot be easier than this. But then also many students have done mistake. Yes, now come to the solution. Employee, you can see 751 timeline I have already drawn. Employee given is 750, option is 250 shares, exercise price 445, and fair value is given 75. Fair value of option, not fair value of equity shares. It is fair value of option we need to take into consideration. In the first year, 25 employees left, and expected number of employees to leave is 35. In the second year, 275 employees left, and expected number of employees to leave is 135. And at the end, means on vesting day, 400 employees remain. Out of that, 375 exercise the option, 25 employee has not exercised the option. For that, we need to do one working note. You can see this favorite working note. Simple. So here you can see first year working will be what? How many employee? So 750 minus 25 minus 35. It will come how much? It will come 690 employee. So you can see based on 690 employee into 250 option into 75 into 1 by 3, that become cumulative expense of first year, and that will become only the expense of the first year, means 43,12,500. Then second year it will be 750 minus 25 minus 275 minus 135. This will come how much? This will come 315 employee. So based on 315 employee, we need to calculate cumulative expense at the end of second year. So 315 into 250 into 75 into 2 by 3, this become cumulative expense up to the end of second year. And this, if this minus this, you can see cumulative expense has reduced. So this will be 3,75,000 negative, means this will become reduction in EB expense. Reduction in EB expense. Then last year, based on the actual number of employees, that is given 400 into 250 into 75 into 3 by 3, the total cumulative expense becomes 75 lakh minus this. This will become EB expense of the third year. Journal entry, very simple. First journal entry, first year journal entry, EB expense account debit to SBB reserve. Okay. Second journal entry, because reduction of expense, SBB reserve account debit to EB expense 3,75,000. Then third year EB expense account debit to SBB reserve, the amount already we have calculated. So if that working note is wrong, so this journal entry is also wrong. No marks will be given for that. So if you have done this working note based on 91, so no marks will be given for that particular calculation. Chalega? Yes, sir. Then on the date of exercise, means at year end 4, 375 employee, the 375 employee exercise the option. So for 375 we need to pass the journal entry for option exercise. So SBB reserve account debit 375 into 250 into 75, then bank account debit with exercise money, so 375 into 250 into 45, then equity share capital with nominal value, and the balance sheet figure will be securities premium account. This journal entry is easy. Then for 25 employees who have not exercised the option, will reverse the SBB reserve and transfer retained earning, the SBB reserve to retained earning for 25 employees into 250 into 75, that is 4,68,750. Chalega? Yes, sir. Yes, sir. Very simple. I think the question cannot be easier than this. But if you have done this working note correctly, okay, sir. So 4A, 4B is also completed. Now come to the next part. Question number 5A. This 5A is also related to one of the question which is in my expected list, related to award point. I used to say in the class that this is expected question, and now the similar question have been asked. Not the exactly same, but I will say the calculation part is same. Big Deal Limited is a marketing company having its departmental store in A class city of India. The company sells the diversified product for the purpose of increasing sales and attract customer. The company during the financial year has adopted the following policy. Okay, sir. For every purchase of 400, the customer is awarded with 6 points. Each point is redeemable on any future purchase of the company's Same department store situated in any of the A class city within 3 years, that is up to 31st March 2026. Okay, value of each award point is 0.60. This is required to calculate standalone selling price of award point. During the current year is 23-24, as is the sales of the company during the year is 150 lakh. Awarded 2,25,000 point to the various customer during the year, even though it is not given, you can calculate 150 lakh divide by 400 into 6. How much it is coming? 150 lakh divide by 4 into 6. It's coming 2,25,000. So this point can be this 2,25,000 point can be calculated. Estimated out of awarded point, 54,000 point will remain unredeemed at 31st March 2024. Means out of 2,25,000 minus 54,000, how much redeem? So 1,71,000 points are redeemed in the current year. And 54,000 is not yet redeemed. So that will redeem in the next 2 years. They are giving out of 54,000 points. They are expecting only 75 points will be redeemed in the future. As an accountant of a company, you are required to suggest the accounting treatment consolidated journal entry. So they have asked one journal entry. One journal entry you need to give one compound journal entry. How should the sales and redemption transaction be recognized and recorded as an independent transaction in the year as per Ind AS 115? Correct. Now very simple. I will say if you have done that question, so you have not done any mistake in this. So what is the total sale during the year? 150 lakh. What is the number of award point? 2,25,000. Value of award point 2,25,000 into 0.60. This is the award point. Value of award point means this becomes the standalone selling price of award point. So there are two performance obligations in the initial sale of the goods. One is what? One is the initial sale, means sale of goods, and the award point whatever has been given. So whatever transaction price allocated to award point will be considered deferred revenue and will be recognized in the year in which the award point is redeemed, or in the year in which the award point is expired, whichever is earlier as per Ind AS 115. So you can see we have allocated the entire transaction price 150 lakh. It is allocated to both the performance obligation in the ratio of the standalone selling price. So standalone selling price of initial sale is 150 lakh and the standalone selling price of award point is 1,35,000. So we have allocated this in that ratio. So this much transaction price which has been allocated to the initial sale of goods will be recognized as revenue in the current year only, and this 1,33,796 will be allocated to award point, which will be recognized in the year in which award point is redeemed. So out of this means out of this some revenue recognized in current year, because out of total award point already I have said that how many award points redeemed in the current year? 1,71,000 points redeemed in the current year. What will be the first journal entry? First, I have given the separate journal entry. Then, of course, we can consolidate also. Means from exam point of view, we need to pass one compound journal entry. The first journal entry will be bank account debit 150 lakh to revenue. This much revenue will be recognized. So this revenue from sale you can add on from sale, and to deferred revenue, or you can add on liability for customer royalty program. Or you can add on to deferred revenue, or you can add on to liability for customer royalty program, or to liability for award points, whatever you want to write down. So this much revenue will be deferred. Now out of 1,33,796, some of the revenue will be recognized in the current year. How much? So you can see 1,71,000 points were redeemed out of how much point which are expected to be redeemed. So you can see 1,71,000 and out of 54,000, 75% were expected to be redeemed. So you need to divide by the total number of points which are expected to be redeemed. That will be 2,11,500. So proportionately we recognize revenue in current year, that will be 1,08,175. So 1,08,175 will be also recognized revenue in current year. So what you can do? You can pass one compound journal entry. कि bank account debit how much? 150 lakh to revenue from sale how much? 148 66 204. Then revenue from award point, that is 1,08,175 then to deferred revenue, yeah, to liability from customer royalty program or whatever. That is how much? 133 796 minus 108 175, that is come 25621. Chalega, this journal entry you can pass, one compound journal entry you can pass, this journal entry is also okay. Have you understood? Means this because they have about consolidated journal entry, so this journal entry is only preferable in exam. Okay sir? Yes sir. This also done. Now let us come to the next point. So question 5a also was simple. If you have done that type of question, whatever we have taken in the class, and that question was also in my expected list. Coming to question 5b, this is a question related to Ind AS 101. However, this question was also in my expected list, and out of means from that question there were 6 points. Out of that 6.2 points have been asked in exam related to Ind AS 101. So this is also same question in ICS study matter, I will say. Jet Limited, having a net worth of 25 crore, has opted voluntarily to adopt Ind AS on 1st April 2002 in accordance with the company's Indian accounting standards. Now they have given Mr. A as senior manager of Jet Limited has identified the following issues. Correct. What are the issues? Point number 1. As part of PP, company has elected to measure land at its fair value and want to use fair value as deemed cost on a date of transition. The land was acquired for consideration for rupees 5 lakh. However, the fair value of land on the date of transition is 6 lakh. So of course, can I say as per Ind AS 101, in opening Ind AS balance sheet, can I say we can avail deemed cost exemption, and deemed cost can be either fair value on the date of transition or it can be carrying amount as per previous GAAP on the date of transition. So this is okay. We need to only give the analysis of that. Company had taken a loan from another entity. The loan carries an interest rate of 7%. It had incurred certain transaction costs while obtaining the same. It was carried at cost on initial recognition. The principal amount is to be repaid in equal installment over a period of loan. Interest is also payable at the end of each year. The fair value loan on the date of transaction is 2,80,000 as against the carrying amount of loan, which is presently equal to 3 lakh. Now management want to know the impact of Ind AS in the financial statement company for its general understanding. Prepare Ind AS impact analysis report. Means you need to prepare Ind AS impact analysis report for Jet Limited for presentation to the management, wherein you required to discuss the corresponding difference between earlier Indian GAAP, IGAAP means AS accounting standard, and Ind AS against each identified issue and its impact thereupon for the preparation of transition date balance sheet. Also past journal entry. Means if you have not given that report, you will not be given marks. If you have given only journal entry, marks will not be given. So it is a question of 5 marks. So I will say 2 marks for 2 journal entry and 3 marks for preparing the report. So you need to prepare the report in this way. How to prepare the report? This is the report. First issue is what? Fair value as deemed cost for property, plant, equipment. As per AS 10, PP is recognized under cost model. However, under Ind AS 101 allow entity to elect to measure PP at fair value or previous GAAP carrying amount as deemed cost on the date of transition. The company has decided to adopt fair value as deemed cost. Since fair value is more than carrying amount, the difference will be transferred to revaluation as surplus, that is other equity. So PP account debit to revaluation surplus, this will be journal entry. The difference will go to the revaluation surplus. Very easy. Second, borrowing transaction cost. As per AS, transaction cost will be charged to profit and loss account. It can be capitalized also as per AS 16. So either it will be charged to P or capitalized as per AS 16. AS 16 means borrowing cost. However, as per Ind AS, Ind AS such cost will be amortized over the period of the loan. And as per Ind AS 101, if the entity cannot apply, cannot identify the effective interest rate or cannot adopt effective interest rate retrospectively, then what Ind AS 101 says that you can consider the fair value as the deemed amortized cost on the date of acquisition, on the date of transition. So it will be new amortized cost of that financial liability on the date of transition. So what is the fair value? It is given 1,80,000 and the carrying amount is given 2 lakh. The difference will be transferred to retained earning. So what journal entry will do? Because your borrowing will decrease, the borrowing account debit retained earning 2 lakh. This will be the journal entry. Simple. So similar question is there. So no discussion required much. 5C, define the concept of offsetting. Is offsetting permitted under? Same to same question is given in Ind AS 1. Same to same question is given in my expected question list. So of course offsetting is allowed or not? Of course offsetting of any income and expense or of liability or asset is allowed if Ind AS permitted or if it is based on the substance of the transaction. So you just write down, define the concept of offsetting, write down as per Ind AS 1, and if permitted or not. So in this, whether profit on sale of the asset, again loss on sale of another asset can be offset. Yes, it can be offset if it is related to the group of similar transaction. If the amount is material, then we can present the gain or loss separately. Expense incurred by holding company on behalf of subsidiary which is reimbursed by the subsidiary, whether in separate books of holding company, the expenditure and related reimbursement offset can be offset. Yes, because it is nothing but as per the substance of the transaction, the offsetting can be allowed. Correct? Whether service are rendered in a transaction within an entity and service are received from the same entity in two different arrangements, the receivable and payable can be offset, because this will be financial liability and financial asset as per Ind AS 32. Yes, it is allowed if the two conditions are satisfied. So if that two conditions are satisfied, it will be allowed, otherwise not allowed. So you can write down in detail. This I have not given the solution. I have just written Kirifa question number 25 of my question bank Ind AS 1. Correct now. I have not given because theoretical answer is there. Question 5C means either you do this or this. Explain how enhancing qualitative characteristic can improve the usefulness of financial information related to conceptual framework chapter. So I have written refer question number 10 of chapter number of question bank directly from that particular question list. Question number 6A, what is this? This is also related to Ind AS 1 and 5. Once again I will say to identify how many performance obligations are there. So in this you need to identify how many performance obligations are there as per the concept of Ind AS 1 and 5. Entity provide broadband services to the customer along with the voice call services. Customer buy modem from the entity. However, the customer can also get the connection from the entity and modem from any other vendor. The installation activity requires limited effort and the cost involved is also insignificant, so therefore we'll ignore installation activity. It has various plans whether it provides either broadband services, voice call services, both. So can I say in this case, all the whatever goods and services are provided, they are capable of being distinct, because customer can either benefit on its own or from any other readily resources available, and they are also distinct in the context of contract. Means neither integration services are provided, nor there is any customization or modification, nor the goods or services are highly interrelated or interdependent. Therefore there are three performance obligations in the contract. However, same to same question is given in ICI study module. It is given my question bank, same to same question. So I have written refer question number 11 of Ind AS 115 of my question bank. You can refer it. Chalega. Coming to question number 6B, this is also directly from ICI question bank, directly questions. Correct now. Creative Limited perform a revaluation of all the plants and machinery at the beginning of the year. The following information relate to one of the machinery. Gross carrying amount itna, accumulated depreciation is 1,60,000, net carrying amount is 2,40,000, fair value is given itna. The useful life of machinery is 10 years and the company uses straight line method of depreciation. The revaluation was performed at the end of the 4 year. You are required to advise how the company should account for revaluation of plant and machinery and depreciation subsequent to revaluation. Depreciation subsequent to revaluation also pass journal entry in relation to the above. You need to pass journal entry. So if you remember, there are some technique given about the accounting treatment. There are two technique 1 and technique 2. We have discussed that about presentation of the item of PP in the balance sheet. So as per Ind AS 16, when the item of PP is revalued, the carrying amount of asset is adjusted to the revalued amount on the date of revaluation. Ind AS 16 has prescribed following two alternative technique. Technique number 1 is what? Gross carrying amount will be restated proportionately to change in the carrying amount. Means will restate the gross carrying amount in relation to carrying amount. So you can see how we'll do. 2,40,000 is the carrying amount. Understood? Fair value is 3 lakh. This is net carrying amount after depreciation. So what is the surplus? Surplus 60. So how much increase? Increase is 25%. So we'll increase the gross carrying amount by 25%. So how much increase in gross carrying amount? 4 lakh into 25%, that is 1 lakh. And accumulated depreciation will also increase by 1,60,000 into 25%, that is 40,000. We'll pass one journal entry. PP account debit. PP will increase by 1 lakh, that is gross carrying amount. and accumulated depreciation will increase by 40,000 and difference will be transferred to OCI, that is revaluation surplus. This is technique number 1. Technique number 2, accumulated depreciation is eliminated against the gross carrying amount of the asset. So whatever accumulated depreciation, we need to eliminate it and that will become nil. We'll pass only two journal entry. First we'll eliminate accumulated depreciation to PP 1,60,000 and then we'll pass one more journal entry, PP account debit to OCI revaluation surplus with the amount of surplus, that is 60,000. In this case the gross carrying amount will become how much? Will be equal to fair value, that is equal to 3 lakh. How it will become 3 lakh? You can see it was 4 lakh initially, minus will do 1,60,000 and plus will do 60. It will become 3 lakh, that is equal to fair value. To reflect the fair value, and the accumulated depreciation will become 0. Will become 0. However, in both the cases, because they have said ki calculated depreciation also. Useful life of the machinery is 10 years. The revaluation was performed at the end of 4 years. Means 6 years will be the remaining useful life. 6 years will be the remaining useful life. Correct now. So you need to depreciation subsequent to revaluation also you need to find out. So depreciation subsequent to revaluation will be 3 lakh divided by 6. So 3 lakh divided by 6 is equal to how much? 50,000. In both the cases. In both the cases, sorry. One minute. It is 50,000. Okay, sir. Correct. So in both the cases, depreciation will remain same. So depreciation will be the revised carrying amount. Revised carrying amount in both the cases will be 3 lakh. So 3 lakh divided by 6 is equal to 50,000. Understood? Understood. In both the cases, once again I am saying both the cases, the subsequent depreciation will be 3 lakh divided by 6. Okay, sir. Done. That I have not written. If you want to write down, subsequent depreciation will be 3 lakh divided by 6, that is 50,000. Okay, sir. Done. Next point. Coming to next point, and question number 6, the last question of the entire question paper, the descriptive part. You are required to analyze the following cases and advise whether they are related with prior period error or changes in accounting estimate related to Ind AS 8. Once again, conceptual question. There is no such question in ICI module or wherever. As per the judgment of the court, in arrear, judgment of court, an arrear of salaries and wages relating to the previous year amounting to rupees, this is how much? 15 lakh will be paid in the current year. At the end of previous year, the management of the company was of the opinion that arrear of salaries and wages would not be required to paid, and accordingly no provision was made at the end of the year. So can I say, as per the best information available at the end of the year, no provision was recognized, and now some new development came and now the provision need to be readjusted, and because of that reason we need to recognize an expense of 15 lakh. So this is changes in accounting estimate. So point number A is changes in accounting estimate, no doubt about that. Correct? You are required to analyze, you need to give the reason of that. So of course, because this is related to estimate, which is due to the new information, new development, this will become changes in accounting estimate. Expense, and there is no error. Means error will come when such information was available when the financial statement are approved and such information were not taken into account for preparation of financial statement. Then it will become an error, because that information was not available when the financial statement of that year was approved. Therefore, it is not an error. Expense of rupees 1,50,000 previous year which were omitted from the books of account of previous year due to an oversight. This is an prior period error. No doubt about this. The amount of provision for doubtful debt as at the end of previous year was 10 lakh, of which 6 lakh were realized during the current year. Changes in accounting estimate. Wherever provision, it will be changes in accounting estimate. Company had taken a group insurance policy. During the previous year, due to mistake of insurance company, the company paid less premium. Not just that, during the previous year, due to the mistake of insurance company. Due to mistake of insurance company, means insurance company has demanded that premium and therefore we have paid that premium and therefore we have recognized that much expense only. which insurance company is demanding to pay now. Now in current year they are demanding some more premium about previous year. So that information was not available in the last year. So this is not an error. This is not an error. So of course this is, I will say, this is not a changes in accounting estimate because last year you have not done any estimation of that. But you can say it is not an error. It is, you can say it is a changes in accounting estimate, or you can say this is an item of current day only. You can write down that. Okay, so A, B, C, D. I hope you have understood. 4 marks. Only one line. If you give explanation, they will give you marks for that. Chalega. So with this, we have done the entire discussion of the descriptive part also. MCQ already we have discussed in the previous video. So 100 marks or paper we have discussed. I think 100 marks not. It is 114 marks. Correct. All the paper we have discussed, and I hope you have understood the entire solution. If you find that your answer is not matching with my answer, or you have some different opinion about any answer, you can provide that information to me by way of message in the comment box. I'll be waiting for your message. Already I have informed you that if you want me to come live online to discuss all your queries related to your answer, already I have said that we'll fix one point of time where I will come online to discuss your query. But for that one target, I have already informed you that I want 100 like and 100 comment in this particular video. If that target is achieved, of course I will come online to discuss all your queries. I hope you like the entire video. This will really help you. Really help you, and share this video with all your friends. Okay, sir. Thank you very much. All the best for your exam result. Till then, bye bye. Take care. Love you all.